Revenue of $806 million, up 5.8% on an organic constant currency basis. Diluted adjusted EPS of 1.98, up 5.3%.
Right, and a total reaffirmation of their full year 2026 guidance.
Exactly. Targeting total revenue of between $3.19 billion and $3.24 billion.
Straight to the numbers. I mean, those are the headlines you need for your models.
Yeah, we are completely stripping away the corporate fluff today to analyze Verisk's Q2 earnings report.
No throat clearing, just straight into it.
As financial analysts, our mission for you, the listener, is to figure out exactly how this data analytics and technology giant is monetizing risk. We're looking at how they're generating cash and, navigating some pretty hidden headwinds.
Right. It's a critical company to understand if you were looking at the financial sector.
Definitely. We're going to look at the global insurance industry's reliance on their data, the margins they're pulling in, and some very interesting legal battles buried deep in their 10Q filing.
Yeah, you really have to dig for those. But honestly, if you remove Verisk from the equation, the entire insurance industry would essentially lose its ability to coordinate its movements.
Think of Verisk as the central nervous system for the insurance industry. They process the world's most complex risks into actionable data for underwriters and claims adjusters.
It's the fundamental architecture. And looking at that $806 million top-line number for the second quarter, you can really see the operational engine humming.
Yeah, and just to be clear, for anyone updating their spreadsheets, when we say that 5.8% top-line growth is on an organic constant currency, or OCC basis, we are stripping out the noise, right?
Exactly, removing all the foreign exchange rate fluctuations.
And any revenue bumps from recent acquisitions, just so we can see the actual underlying heartbeat of the business.
Yeah, the OCC metric is by far the truest gauge of demand for their core products. And that demand is structurally split into two main segments, which are underwriting and claims.
Let's break those down. So underwriting generated $569 million in the quarter.
Which is a solid 5.6% increase on an OCC basis.
Right, and claims brought in $237 million,
Ooh.
up 6.1% OCC. But I want to pause on the underwriting side for a second.
Sure.
What exactly are they selling that drives a mature business to consistently grow at nearly 6% organically?
Well, it really comes down to pricing power and essential infrastructure. I mean, the growth in underwriting isn't just about selling to more customers.
Right, it's not just volume.
No, it is heavily driven by price increases. Verisk provides the absolute baseline content for insurance policies.
Like the standardized forms and actuarial rules?
Exactly. Forms, rules, loss cost services. If you are an insurer, you base your entire premium structure on Verisk's loss cost data.
Right, because building that internally would be impossibly expensive.
Oh, yeah. And because Verisk is constantly enhancing these models, updating them with new catastrophe data or changing cyber risk profile, they have the leverage to just raise prices annually.
And the insurers basically have to pay it.
They do, because using outdated risk models is a fast track to insolvency.
That makes total sense. It's just the cost of staying relevant in the risk business.
Mm-hmm.
And then, over on the claims side, that $237 million is largely being driven by anti-fraud analytics, right?
Yep, anti-fraud and their property and restoration solutions.
Which, if you think about the macro environment, when economic conditions tighten up, insurance fraud typically rises.
It always does.
So those anti-fraud analytics transition from a luxury software add-on to an absolute necessity for an insurer's bottom line.
Yeah, it's a highly defensive business model. But to really understand the durability of these numbers, you have to look beyond just underwriting and claims.
You have to look at the revenue mix.
Exactly. How they actually bill for this software. You have to look at the split between subscription and transactional.
Yes. This is a metric you definitely need to watch if you are analyzing Verisk. A massive 83% of their total revenue is subscription-based.
That's a huge chunk.
And that subscription revenue saw a very strong 8.0% OCC growth. But the remaining 17% of the mix, the transactional revenue, actually declined by 4.2% OCC.
Yeah, that divergence is super interesting.
Why the split there?
Well, it highlights the difference between operational budgets and real-world volatility. I mean, the subscription growth is their economic bedrock.
Those are the multi-year contracts, right?
Multi-year contracts that insurers just bake right into their foundational budgets. They pay a flat fee for continuous access to Verisk's data feeds.
Got it.
But the transactional piece, that 17%, that's usually billed on a per-click or per-claim usage basis.
So it fluctuates with actual real-world events.
Exactly. That's where you see the volatility of the physical world actually impacting the financial statements.
And the earnings report calls out 3 specific drags on that transactional revenue. First, lower weather-related volumes in property and restoration solutions.
Which is a big one.
Second, tough comparisons from last year's property underwriting overages. And third, lower volumes in their travel business, and that was related to Middle East travel disruptions.
Right. So if we unpack those mechanics, the weather impact is actually fascinating.
Yeah, how does that work?
Well, transactional revenue in insurance tech basically means that if it's a mild weather quarter, fewer storms, fewer roofs get damaged.
And if fewer roofs get damaged?
Exactly. Fewer claims adjusters are logging into Verisk's software to run a repair estimate or pull an aerial measurement. Every time an adjuster doesn't click that button, Verisk misses out on a microtransaction.
Wow, okay. And what about those tough comps from last year?
So last year, they saw a massive spike in clients going over their allotted underwriting data limits.
Oh, triggering overage fees.
Yeah, exactly. But this year, client activity just normalized, so those overage fees disappeared.
I have to challenge the narrative here, though. Transactional revenue took a 4.2% hit precisely because of unpredictable weather and unpredictable geopolitical events.
Sure.
Does this highlight a structural vulnerability in Verisk's model? Like, they're at the mercy of the weather.
I'd actually say it proves the exact opposite. It reinforces the strength of their financial moat. Well, imagine if a software company were relying on a 50-50 split between subscription and transaction.
Right, that would be rough.
A quiet weather quarter or a geopolitical flare-up could absolutely decimate their quarterly earnings. But Verisk has engineered the business so that 83% of the revenue is locked into sticky, recurring subscriptions.
So the subscription base acts as a buffer.
Exactly. Because that 83% grew at a robust 8%, it mathematically just absorbed the 4.2% drop in the transactional segment without breaking a sweat.
Which allowed them to still post that 5.8% overall top-line growth.
Right. The subscription moat essentially subsidizes the volatility of the transactional business.
And you can really see the power of that moat when we move down the income statement to look at their margins.
The margins are incredible.
Yeah. Knowing that 83% of the revenue is locked in naturally leads us to ask how efficiently they are running the machine. Despite spending heavily on new technology this quarter, their adjusted EBITDA margins remained incredibly healthy at 57.5%.
Which is just massive.
Yeah, that translates to $464 million in adjusted EBITDA for Q2 alone.
Sustaining a 57.5% margin is a massive testament to the operational discipline of the management team. I mean, data businesses scale beautifully because the unit economics are so favorable.
Because the hard part is just building the data in the first place.
Exactly. Once Verisk builds a proprietary data set, say, a model on wildfire risk in California selling access to the 100th customer costs essentially nothing compared to compiling the data for the first customer.
Right. Most of the incremental revenue falls straight to the bottom line.
Exactly. But the key is that you cannot let the data become commoditized. You have to aggressively invest to protect the asset.
And they are definitely deploying capital to defend it. CEO Lee Shavel is hyper-focused on injecting advanced AI across their proprietary datasets.
Yeah, they are not sitting still on the tech front.
The report details that they've launched 2 MCP connectors with Anthropic's Claude. They've updated the U.S. tropical cyclone model.
Which is huge, given the recent weather volatility.
Right. And they introduced 7 new modules for what they call Core Lines Reimagine. And they are targeting a total of 25 releases for that specific project by 2026.
That's a rapid deployment schedule.
It really is. Plus, on the M&A front, they acquired a company called McKinsey Intelligence Services to bolster their geospatial intelligence for event response.
Yeah, and these aren't just buzzwords to appease tech investors. These are highly targeted workflow enhancements.
Break down the Claude integration for us. What is an MCP connector?
So let's look at those MCP connectors with Anthropic's Claude. MCP stands for Model Context Protocol. It is essentially a secure bridge.
Okay.
It allows a powerful AI like Claude to securely connect to Verisk's deeply proprietary confidential data environments without leaking that data back into the public AI model.
All right, because an insurance company absolutely cannot have its proprietary claims data ingested by a public LLM.
It would be a massive compliance nightmare.
So the MCP connector allows an underwriter to use Claude to instantly parse a complex, maybe a 200-page commercial insurance policy, cross-reference it against Verisk's historical loss data securely, and output an exact risk profile in seconds.
Exactly. It changes the underwriter's workflow from, manual data extraction to high-level analysis.
That's a huge time saver.
It is. And then look at the McKinsey Intelligence acquisition. That brings advanced satellite and drone imagery directly into Verisk's ecosystem.
So real-time visual data.
Yeah. So imagine an adjuster sitting at a desk after a major hurricane hits Florida. Instead of waiting days to send a human inspector into a disaster zone, they pull up Verisk's platform.
And they just see it all from the disk.
Right. They have real-time, multi-layered spatial intelligence showing exactly which roofs have been compromised, and it's overlaid with Verisk's predictive repair costs.
It sounds like they're building an Iron Man suit for insurance adjusters.
Oh, that's exactly what it is.
They are layering Claude AI for the heavy cognitive lifting and geospatial intel for superhuman vision. And it's all built over their base actuarial models.
That is the perfect way to visualize it. And that directly ties back to the 5.8% revenue growth and the pricing power we discussed earlier.
Because the product is just that much better.
Right. They are upgrading the user experience so significantly that when the multi-year subscription renewal comes around, the insurers don't even blink at a price hike.
Switching costs are too high.
Exactly. The operational cost of dropping Verisk and forcing your adjusters to take off that Iron Man suit would be far more damaging to an insurer's efficiency than simply paying the higher fee.
I see the logic there. But I'm looking at these margins and something isn't adding up.
Okay, what are you saying?
Adjusted EPS is up, but GAAP net income actually dropped 9.8% to $229 million. And GAAP diluted EPS fell 3.3% to 1.75.
Right, the GAAP versus non-GAAP disconnect.
Yeah. If the core machine is humming so beautifully, what exactly are they stripping out of these adjusted numbers to make them look so good?
Well, this is where rigorous analysts earn their keep. You really have to bridge the gap between GAAP and non-GAAP metrics to see the full financial picture.
Because they can hide a lot in the adjustments.
Exactly. In Verisk's Q2 report, there are 3 distinct non-operating drags pulling down the GAAP earnings.
Okay, let's investigate the first one. A higher effective tax rate. They paid 24.6% in taxes this quarter versus 22.7% last year.
Yep.
The earnings release explicitly ties this to lower tax benefits from equity compensation. How exactly does employee stock affect the corporate tax rate?
It's an accounting mechanic. So when employees exercise their stock options, the company often gets a tax deduction based on the difference between the strike price and the market price.
Oh, I see.
Right. If fewer options are exercised in a given quarter or, if the stock price dynamics change, that aggregate tax benefit shrinks.
And when the deduction shrinks, the effective tax rate mathematically goes up.
Exactly. It is a real cash difference, but management adjusts it out of non-GAAP earnings because it represents a fluctuation in employee behavior and market timing.
It's not a flaw in the core software business itself.
Exactly. It doesn't tell you how well they are selling data.
Okay, that makes sense. Now, the second drag is higher net interest expense, which jumped to $52.8 million.
Which is a pretty significant jump.
Yeah. This is coming from their 364-day term loan facility and the new 2031 and 2036 senior notes they issued earlier this year.
Right. So they are carrying roughly $4.5 billion in total debt now.
Wow.
And when a company takes on new senior notes in a structurally higher interest rate environment, whether that's to fund operations or share buybacks, the interest expense naturally climbs.
Which, again, is a very real cash cost.
Very real. But it is excluded from metrics like adjusted EBITDA because it relates to how the company chooses to structure its capital rather than, how well it operates.
Right. But it's the third GAAP drag that I actually find the most alarming.
The legal fees.
Yes. Increased legal fees from ongoing litigation. When you dig into the 10Q filing, they are fighting some intense multi-front legal battles.
They really are.
They are in the Delaware Chancery Court over a disputed merger termination with Acculings. They are facing a lawsuit from JPMorgan Chase alleging misappropriation of trade secret data regarding Verisk's Argus business.
That's a big one.
And they are wrapped up in patent and trade secret litigation with General Motors and OnStar regarding connected car telematics data.
Yeah, analysts need to watch these trade secret allegations very closely.
The Acculings one seems normal, right?
Yeah, the Acculings situation is a standard broken deal dispute. But the lawsuits involving JP Morgan and General Motors strike right at the nerve of Verisk's business model.
because their whole model is aggregating data.
Exactly. Verisk relies on aggregating third-party data, anonymizing it, analyzing it, and selling the insights. The JP Morgan case involves banking and credit data.
And the GM one.
The GM and OnStar case involves telematics, specifically how millions of people physically drive their cars.
Which is the holy grail for auto insurance pricing.
Exactly.
Wait, so why are GM and OnStar fighting them over telematics? Are these legal battles just the standard cost of doing business when you're hoarding the world's most valuable risk data? Or does this signal a genuine existential threat to how Verisk gathers its raw materials?
Honestly, it signals a massive shift in the broader data economy. These are huge, data-rich corporations clashing over the exact legal boundary of data usage.
Who actually owns it?
Right. GM collects the telematics data from the vehicles. If Verisk is using that data in a way GM claims violates trade secrets or patents, it challenges the whole concept of data provenance.
So if a court ruled against Verisk,
If a court were to fundamentally restrict how Verisk ingests or utilizes third-party data streams, it could force them to alter their predictive models.
and if the raw material is restricted, the AI and the models just become less effective.
Exactly. For now, it is just driving up JAP expenses via millions in legal fees, which, again, management excludes from adjusted EBITDA. But the long-term risk there is very real.
So if they are absorbing millions in legal fees and higher debt interest, how are they funding these massive AI investments and acquisitions?
Well, this brings us to the actual cash they are printing.
Right. Despite the JAP headwinds, free cash flow skyrocketed 57.9% to $298 million for the quarter.
I mean, a nearly 60% jump in free cash flow is staggering.
It is. The earnings release notes this was driven by higher operating profit, but also heavily influenced by the timing of certain vendor and tax payments.
Yes, yeah, the timing played a part. But when you have a 57.5% EBITDA margin and incredibly low capital expenditures, I mean, they only spent $68 million on CapEx this quarter. A huge percentage of that $806 million in revenue flows straight to the bottom line as cold, hard cash.
And management is aggressively pushing that cash right back to the shareholder.
Oh, absolutely.
They have returned roughly $2 billion to shareholders year to date.
That's a massive capital return program.
Let's detail the buybacks because they executed a $200 million accelerated share repurchase, or ASR, program in the second quarter.
Right, the ASR.
They received an initial delivery of about 949,000 shares at $179.10 each. In total, between the ASR and open market repurchases, they retired 8.5 million shares in just the first half of 2026.
Just aggressively shrinking the float.
Yeah. So if you're modeling the EPS, how does an ASR differ from them just buying stock on the open market?
So an ASR is a much more aggressive capital return strategy. Instead of buying shares slowly, day by day on the open market, a company hands a massive chunk of cash to an investment bank.
Right.
In this case, for their larger $1.5 billion ASR earlier in the year, they use HSBC and Wells Fargo. The bank borrows the shares and delivers the vast majority of them to Verisk upfront on day one.
So Verisk gets them all at once.
Exactly. Verisk immediately retires those shares, instantly shrinking the float. The bank then buys shares in the open market over the next few months to cover their short position.
Okay, so for analysts, the ASR provides an immediate mechanical boost to that diluted adjusted EPS number because the denominator of the share count shrinks instantly.
Bingo. That explains a good chunk of the 5.3% bump in adjusted EPS.
And on top of that, they are paying dividends.
Right.
They paid out 50 cents per share in June, and the board just approved another 50-cent dividend for Q3. They are executing this massive capital return while maintaining a very manageable debt profile.
Yeah, they really are.
Their debt-to-EBITDA ratio is sitting at 2.5 times, and they hold solid investment-grade ratings, buy one from Moody's and BBB from S&P.
Carrying 2.5 times leverage is very comfortable for a business where 83% of the revenue is sticky subscriptions.
Yeah, lenders love predictability.
They do. But the sheer scale of the capital return, $2 billion in 6 months, it should make you pause and evaluate their capital allocation strategy.
That is exactly what I am wondering. With $2 billion aggressively returned to shareholders through buybacks and dividends already this year, is management signaling that their own stock is simply their best investment? Or are they lacking major M&A targets that could drive organic growth?
Honestly, if we look at the broader financial landscape, it's a combination of both factors, and it's driven by macroeconomics.
Right.
In a higher interest rate environment, the hurdle rate for a transformative multi-billion-dollar acquisition is incredibly high.
Taking on new debt is expensive.
Exactly. And the valuations of potential tech targets haven't always come down to match that new cost of capital. So management is essentially looking at the board and concluding that they already generate immense cash, and their subscription moat is incredibly strong.
So it's safer to just buy their own stock.
Right. Buying their own stock at these levels yields a safer, more guaranteed return for their investors than overpaying for a competitor and risking integration issues.
Yeah, that makes sense. They are still making strategic bolt-on acquisitions, like McKinsey Intelligence,
Yeah.
but the big money is being used to bet on themselves. So as a financial analyst modeling this company, what is the ultimate takeaway? As climate change creates more unpredictable weather events and global geopolitical risks accelerate, Verisk's predictive data is undeniably more essential than ever to the functioning of the insurance industry.
It's totally critical infrastructure.
The AI investments and the pricing power are very real. However, their ongoing legal skirmishes with giants like GM and JP Morgan suggest something much larger about the macroeconomic environment.
Yeah, the data ownership issue.
Right. It suggests that the future battle in the information economy won't just be about who has the best Claude integration or the best AI to analyze the data. The real risk is a bare-knuckle legal fight over exactly who owns the raw data in the first place.
Precisely, because the predictive models are only as good as the raw materials fed into them.
Yeah.
If the legal boundaries of data ownership tighten up, securing those raw materials will become the primary battlefield.
And that is exactly what you need to be monitoring in their future filings. For your daily dose of concise, no-fluff earnings coverage just like this, make sure you hit follow on the show. See you on the next deep dive.